Welcome to the Deep Dive. Today, we're looking at a huge shift in how we all buy and sell things. We're tracing the story of a company that started with just a tiny white dongle Square and grew into the absolute financial giant we now call Block. And our sources for this, they lay out a really fascinating journey. So our mission in this deep dive is to understand how this company, co-founded by Jack Dorsey, just completely shattered the barriers for millions of small businesses. We're talking micro-entrepreneurs, pop-up vendors, people like that. And we want to see why its model became really the blueprint for modern FinTech.
It's a perfect case study, it really is, because this isn't just about a cool piece of tech. It's a story about solving problems that the big financial players, they just thought were too small to even bother with. We're going to look at how they built this incredible two-sided network with tools for merchants on one side and then on the other, creating a consumer super app that totally changed what we all expect from personal finance.
Okay, let's jump right in with that initial spark. The year is 2009, and the origin story is almost famous at this point. Jim McKelvey, he's a glassblower, and he loses a big sale. Why? Because he couldn't take a credit card.
Exactly. And that little story, it seems small, but it points to this massive systemic problem. You have to remember what the world was like before Square. If you wanted to accept a credit card, it was a nightmare.
Just a bureaucratic mess.
A total mess. If you were a food truck, an artist, an independent contractor, you had to apply for a merchant account, pay these high monthly fees just to have the service.
Whether you made a sale or not.
Right. And you had to negotiate these incredibly complex interchange rates and often lease this clunky, expensive terminal hardware.
So the whole system was basically set up to serve big established businesses.
Yeah.
Everyone else was just too much trouble.
Too much trouble, too much of a risk, too much of a regulatory burden. The banks had zero incentive to make it easier. Their profit models depended on those high fixed costs and these slow, totally opaque processes.
So when McKelvey and Dorsey saw this, the question wasn't just, how do we build a better terminal?
No, it was much bigger. It was, how can we use digital technology to just completely bypass these gatekeepers? How do we democratize access to the economy itself?
And the answer was that little white reader, the one that plugged into a smartphone's audio jack. It was so simple.
Deceptively simple. It wasn't just a gadget. You called it a Trojan horse earlier, and I think that's perfect because it wasn't really about the hardware. The real revolution was the philosophy behind it. The move to a transparent, flat-rate, pay-as-you-go model.
No more monthly fees.
None. No minimums, no long approval process. Square just said, look, we'll take a small, simple, understandable percentage of every transaction. That's it.
And they could do that because they were leveraging the phones we already had in our pockets.
Precisely. They used existing mobile tech and cloud computing to sidestep all the expensive proprietary systems the banks relied on. That's how they kept the costs so low.
And it just took off.
Yeah.
Because they were seen as the champion for the little guy, right? The entrepreneur who'd been completely shut out.
Yes, and they nailed the design, too. Think about those old beige terminals. They looked complicated, intimidating. The Square reader was sleek, simple, almost invisible. That combination, transparency, ease of use, and instant onboarding, it was a winning formula.
But the sources are really clear on this point. Processing payments, that was just the foot in the door.
Just the entry point. They realized very quickly that to really keep their customers, to build loyalty, they couldn't just handle the transaction. They had to help run the whole business.
Which is the big strategic shift, moving into becoming this integrated ecosystem.
And that pivot was brilliant. They went from being a payment processor to being essentially the central operating system for small business. The Square Register, that unified hardware and software platform, it completely upended the point of sale, or POS, landscape.
So tell us a bit more about what that actually means. What did it do beyond just taking a payment?
Oh, it was everything. Everything a small business needed but could never afford or integrate on its own. We're talking inventory management that updated in real time.
So when you sell a coffee, one less cup is available in your system. Instantly.
Instantly. It gave them sales analytics. What are your best-selling items? What are your peak hours? It had employee tracking, time clocks, digital payroll, even a kind of built-in customer relationship management through the digital receipts.
That deep operational embedding.
Yeah.
It feels like a killer competitive advantage. If your entire business runs on Square, your inventory, your staff schedule, your sales data switching to another payment processor is not a simple decision.
It becomes almost unthinkable. You're not just changing your fee structure, you're performing open heart surgery on your business's core operations. The switching costs just skyrocket.
And that loyalty gave them the foundation to just keep adding more services.
Exactly. Invoicing, e-commerce stores, and then the big one, access to capital.
Which brings us to Square Capital in 2014. And this is where I think it gets really interesting. This wasn't just another feature. It was a game changer for how small businesses get money.
This is maybe the best early example of what we now call embedded finance. The idea of weaving financial services directly into a platform a customer is already using every single day.
So instead of the merchant having to go to a bank, hat in hand, and fill out a mountain of paperwork,
The offer just appears. It's right there, integrated into the dashboard. They're already checking for their sales data. No separate application needed.
and it solved that huge problem for small new businesses.
Yeah.
Traditional lenders, they look at credit scores, they want collateral. Many of Square's customers had neither. So how did Square figure out who to lend to?
They used their own data. They had a real-time, minute-by-minute view of that business's health. They knew the daily cash flow. They knew the seasonal ups and downs. That transaction data is so much more predictive of whether a loan will be repaid than a static, old FICO score.
They were looking at dynamic performance, not just history.
Exactly, which meant they could responsibly lend to thousands upon thousands of businesses that traditional banks would have just flat out rejected.
And the repayment system itself was the final piece of genius here. It
Yeah.
totally minimized their risk.
It really did. Instead of a fixed monthly payment, which can be crippling for a small business, repayments were taken as a small percentage of future card sales.
So if you have a slow week,
You pay back less. If you have a great week, you pay it down faster. It aligned everyone's incentives perfectly and offered a flexibility that banks just couldn't match. That model is now, the blueprint for the entire embedded finance industry.
okay, so that's the merchant side of the business. Deep integration, building loyalty, using data to provide capital. But at the same time, they were building this whole other universe on the consumer side, which of course is Cash App.
Right, Cash App. It launched in 2013, and it started out as a very simple peer-to-peer or P2P payments tool. But its success came from being incredibly easy to use and, again, focusing on a group that was really underserved.
It grew so fast. What was the secret sauce? Why did it beat out other competitors in that space?
I think simplicity and speed were huge. But the real insight was to build what was, effectively, a quasi-banking solution for the digital generation and for gig economy workers. It was super intuitive, transfers were instant, and they quickly added a free debit card linked to the account.
Which let people who might not have a traditional bank account operate in the digital world.
Fully. It gave them direct deposit, it offered instant cashback rewards, which they called boosts, and even fractional stock investing. It became the primary financial hub for millions of users who, frankly, felt ignored or poorly served by the big, old-school banks.
But the real rocket fuel, the moment that kicked off its hypergrowth, was when they integrated crypto.
That was the catalyst, no question, starting in 2018 with Bitcoin. When they did that, they didn't just add another feature, they made crypto approachable.
Right, because at the time, dedicated crypto exchanges felt kind of scary and complicated.
Intimidating, complex, and you didn't know if they were secure. Cash App brought Bitcoin access to tens of millions of people inside an app they already knew, used, and trusted. It was a massive deal.
And this really drove home that idea of the financial super app, at least in Western markets. It was clear that users wanted consolidation. They'd rather have one simple tool for payments, banking, and investing than three separate, punky ones.
It just proved that convenience and trust will almost always win. And the more services they packed under that Cash App umbrella, the stickier it became. It was the exact same playbook as the merchant side. Make yourself indispensable by offering everything.
Which brings us to 2021 and the big rebrand. Square becomes Block. And this wasn't just a name change, was it? It signaled a much, much bigger ambition.
Oh, absolutely. The name Block was a direct nod to the blockchain. It was them signaling that their future was incorporating that technology, the decentralized infrastructure, into everything they do.
They wanted to expand way beyond just payments.
Way beyond, into these multi-vertical ecosystems. You had their TBD division, which is focused on building decentralized financial services. They have Spiral, which is a dedicated crypto products arm. And they even moved into content, which I think surprised a lot of people.
You're talking about the acquisition of Jay-Z's Tidal platform.
Exactly. Linking the creator economy directly to these new decentralized financial rails. The vision was clearly that finance, creativity, and decentralization were all going to converge, and Block planned to be the company providing the core infrastructure for all of it.
But that kind of explosive growth, it never comes without challenges. It brings a lot of attention, a lot of headwinds.
For sure. When you're a fast-scaling fintech, you're operating right on that edge between innovation and regulation. And Block has faced some pretty intense regulatory scrutiny, especially around Cash App.
What are the main issues for a platform that big?
The biggest challenges are always know your customer, or KYC, and anti-money laundering AML compliance. Because Cash App is so easy to sign up for, which is its strength, it's also a constant battle to manage fraud and make sure the platform isn't being used for illicit activity. That draws a lot of heat from regulators.
And the competition hasn't exactly gone to sleep.
Far from it. On the merchant side, you've got giants like Stripe going after high-volume businesses. On the consumer side, you've got PayPal and Venmo, plus this whole wave of neobanks and challenger banks. But what the sources point out is that Block's diversified ecosystem is its greatest strength here. When the consumer side sees volatility, the merchant business is stable. When crypto adoption drives huge growth, it can fund other bets. That portfolio model helps them weather big economic shifts, like rising interest rates, way better than a company that only does one thing.
So if we were to boil this whole incredible 15-year journey down, what are the key lessons for you, the listener, who's trying to make sense of all this?
I think you can distill it to 4 really profound takeaways. The first is that huge innovation often starts by solving a small, annoying, overlooked problem, like the glassblower who couldn't take a credit card.
Number 2 would be the power of ecosystem thinking. The real value today isn't in a single product. It's in building a platform where all the services are interconnected, making you indispensable to your customer.
Third, and this one is so important, is that data transforms credit. Block proved that alternative ways of assessing risk using real-time data instead of old credit scores can radically expand financial inclusion. It gets capital to people who were previously ignored.
And the fourth, which sounds simple but is so hard to do, is that user experience wins. Low friction, simplicity, intuitiveness. In a crowded market, the easiest and most comprehensive product is often the one that succeeds. That's the story of Cash App.
Yeah, you look at their impact, and it's undeniable. They redefined card acceptance, they empowered millions of small businesses around the world, and they democratized access to digital currency.
So what does this all mean for the future? Block built its empire on creating this incredibly integrated, centralized infrastructure for both merchants and consumers.
Which leads us to our final provocative thought for you to think about. As Block moves into its next chapter focus on decentralized finance, Web3, all these open protocols, well, the very thing that made them successful, building this powerful centralized system, eventually clash with the core philosophy of true decentralization. In other words, does Block become the essential on-ramp to this new digital age, or does its dominance just create a new, more powerful kind of gatekeeper? I think that tension is going to define their story for the next decade.